Good morning, everyone, and welcome to our weekly Unplugged. What a week that's been, huh, guys? Crazy, crazy. What a time to be alive.
Good morning.
Good morning,
Morning.
everyone.
Yeah, I guess it's once in a lifetime. So
It's once in a lifetime. Well, it feels like that all the time, frankly, in crypto. you always say that. It's ETF this week, it'll be something else next week and the week after. Anyway, let's get straight into it. It's clearly been the week of the ETF. So, as always, we'll have some slides up and we can roll into the weekly update. So the week of the ETF, or not ETF, we'll get into the ins and outs of what the ETF is, what it means, how it works, how it compares to the native Bitcoin ETF. How the Bitcoin ETF compares to the native Bitcoin, and what real pros and cons come with trading one or the other. And there's a little bit more that happened this week. So enough of the preamble. Marco, how about we just start?
So basically, first, just a small high-level overview. So the Bitcoin was approved. It's the second time because we had a bit of drama day before when basically the official X account of the SEC has been hacked, and a post that looked like very official was injected saying that all the ETFs were approved. That caused the price to be extremely volatile, and then after like 20 minutes, 15 minutes, the SEC officials, so not that account, so the official account of the company or of the government institution, more about the personal account of Gary Gensler, went out saying, no, this has been a hack. That's not it's not our post. And then they managed to recover access, and they post another clarification. They remove the post itself. So it was a very interesting time, and price went up and down a lot. Talking about customer protection, that was not very protective of the customer. That said, the day after, then on the 10th, there was proof official after American trading hours. Differences here now, just this is the spot. Okay, so what does it mean? Well, first of all, this is a spot. It means that you're still buying a financial instrument. You're not buying directly Bitcoin, you yourself. Okay, so if you buy the ETF, you get exposure to the P&L. So the price, you get exposed to the price of Bitcoin, but you do not hold Bitcoin in your hand. What you hold is a piece of a share, a share of this fund, basically, that is run by Grayscale, BlackRock, and so on, where they have to buy Bitcoin, right? So you buy a piece of a fund that has to hold Bitcoin, and that means that the whole funnel is not anymore as it was before with the future ETFs. It's completely virtual, just exposure to profit and loss. Here is the fund has to buy or to sell, depending on what the operation you do, a certain amount of Bitcoin relative to the amount of US dollar that you inject or withdraw. So now it makes a bit more sense why this is important, because they have the fiduciary responsibility to actually go out in the market and buy it. Now, this is important for this reason, but it's also important because will expose directly, if you follow how the funnel works, traditional finance and big institutions to Bitcoin. Previously, that was not the case. Of course, it was possible at a personal level to buy Bitcoin, but institutions they weren't able. A bank were not able. A a regulated fund could not buy Bitcoin because simply there was no way to satisfy compliance for that. And we should see the difference of a private investor and a institutional investors that the hack is acting on behalf of an institution, regulated institution, is that he had to respect certain regulations and certain laws. So he could not do that, even if he could do this personally. And many institutional players were doing it personal, but it's a completely different game when you do it for your institution. Why is also different and why it's important is because we have to differentiate the mentality and the perception, I would say mostly the perception of what crypto has taught us, and what instead is the institutional effect. Institutional effect means that now this ETF can go into wallets and in portfolios that will be distributed across the whole United States and largely across the whole world. So the timeline for that is a long-term timeline, and it's a timeline of slow accumulation. It's not a timeline of let's buy, let's pump the price, and then 2 days later we sell. That's not institutional. Okay. Here we need to again compare the two mentality. It's like there was a lot of people expecting, as soon as the price as soon as the ETFs come in, price will go up because there's such a huge amount of money that just need to be deployed. I mean, we see it in the table. We see here in the table basically how much of those seed funds, seed money were in these funds. It's not enormous. It's nice, but it's not enormous.
It's still the biggest first day trading day for any ETF ever. So I hear what you're saying, but I think
but I'm talking true. I'm talking about Bitcoin perspective.
Sure.
It was a very high volume day, but it wasn't decent. Potential for the industry to come in is with trillions, right? Globally aggregated in times.
Yeah.
Here we're talking 4 billion. So we are in a scale of 1,000. But we need to understand that that's the shift. That's why we call this as like the singularity event, why it was so anticipated, why it was so important, because from now on, there's going to be distribution of true Bitcoin, not of exposure to profit and loss, towards the whole financial world, because now the whole financial world can get a piece of it. And it's going to be a slow build-up, but there is no turning back. And so we have to now the strategy, if you want to look at this, or even if you look at globally how crypto could move, it's going to be a different. We are going to have this extra flow that is behaving completely different than the traditional, the crypto OG and the crypto degens that pump something 2 months later is out, which is still okay, but we need to differentiate the two sectors. We need to differentiate the two mentalities and understand that sharp increase in price it's not how traditional conservative finance works. If you want to have and I conclude, if you want to have a preview of what could that means, look at the ETF of gold. In the first months, it raised, but it didn't raise crazy. But in a year, 2 year, 3 year, 5 year times, the price of gold went steadily up, made 10x from the ETF. And the most important thing is that since now it's the way how it managed to get there. It managed to get there in pension fund, in investment product and vehicles that buy and stay for 10 years. So the price of gold is where it is and it's going to stay more or less where it is. It will never go back to where it was, because it's so widely distributed that it's almost impossible. And that my point is that's the shape of going up and then staying at a critical mass level, which Bitcoin never had at the cycles of Bitcoins, right? It goes up and then it crashes. It goes up and it crashes. Probably this is kind of something that we could see that was the past. So that's for me why it's a revolution. That's why it's a singularity event, because it is possible that we change the shape of what's going to happen in the future from now on.
Thanks, Marco. So to recap, until the day before yesterday, anyone looking to go long and invest in crypto effectively could only do that through crude, pure crypto circuits, exchanges, wallets, and the likes. The bridges have now been opened to connect the crypto world to the traditional financial world. And whilst, as you put it, Marco, the volumes high given the potential for traditional markets, those bridges are now there. I mean, to put it in context, banks and financial institutions are not as witty and agile to invest, overnight. It takes time to line up a pipeline. There's paperwork. Banks still operate on processes and procedures. No financial advisor would have been authorized to solicit this sort of business until yesterday, effectively open of business. And it will take time for advisory mandates, discretionary asset management mandates to start trickling the money in. So I'm certain, as you say, Marco, that we're going to see continuous flows of assets. What will be interesting to see what or how the traditional financial world will react to large shifts in price. Now, so far, the expectation for all ETF investors from the TradFi world is that, well, there's an ETF now. This thing has been returning, multiple X's in history. This is gonna be an easy trade. What will happen a month from now, a week from now, a year from now, when the market will tank 70% again? How will TradFi respond to that? What are your views on that?
Well, I mean, that's my thing. It's those extreme volatile market situation will become less and less an occurrence and less probable, because the moment you start to transition from people who buy and sell quite often to people that buy and hold. And just remember, there is a bunch of crypto people who buy and hold. Okay, it's not just something that is pertinent to traditional finance, but it's not that traditional finance buy and hold always. It's the type that makes sense. Traders in traditional finance trade, but traders, they only look for exposure to the price volatility. So they were already there in the ETFs if they wanted, related to the futures. Here is trading with the underlying. And trading in the underlying is important because there is so many instruments that actually allow you to put this type of product inside as long-term holders. The 401k in the United States, in Switzerland, we have the third pillar, for example, private pension, basically. Okay, could allocate 0.51% to Bitcoin ETFs, but these plans works 30 years, right? So they buy a little, they do, let's say, do DCA, okay, for 30 years. So it's little by little, and they do not sell because there is a net balance of new entrants and exit. And so it's only accumulate until it reach a level, and then it stay at that level. And once again, I go back to gold. 200, 250 was the beginning of ETF price, then raise up lately to the 2000. Okay, so 10 years difference to around the 2000. Between it was 1.6, then we had the crisis, went to 2000. So this is the fluctuation depending on the market condition. But once you get at 2000, it never went down and it is not going up because it already reached the maximum distribution in portfolio instruments, and then it's just a net zero game. People getting out, selling, people getting in, buying what the people that are sold. So you stay at that level. There is no up and down, just stay there. That long-term scenario, what Bitcoin could do.
Fantastic.
Related to that topic, before we move on, do we know where those BTC are coming from? I mean, where is BlackRock buying BTC? Where are those
BlackRock
coming
specifically Coinbase.
Okay, so they are going through the trading desk.
The custody there.
Okay.
But then you have many other, like you have Fidelity, who is doing it. They already had a crypto desk. ARK, I'm not sure, but I think it's 21 shares. BlackRock does also with 21 shares, I guess. So they have multiple agents.
I think over 50% of the ETFs are using Coinbase, but there are some variations. But just before we move on, should we talk about the fee wars? Actually, I was proposing to put up another slide before using this one as just the latest market view from yesterday. But there's a lot that's happened over literally the last day prior to trading around the fee structure.
Yeah. I think that the fee wars, to be honest, it's related to something specific to finance. Whenever you launch traditional finance, whenever you launch a new fund, and that basically is when you launch when traditional finance launch a new fund, is not like they do it and then they cross their fingers and say, let's hope that everybody's buying. What they do is they do pre-marketing. Okay, they have, first of all, what is called seed funding. This seed funding is some wealthy people or themselves, the institution, placing some money to showcase that there is enough good intention and trust into this product, so you're willing to bet your own money. Then they go out and they marketize this product to their own clients, and they pre-market it. So that means that they have listed out who will be interested and then follow up with them, like normal sales cycle. And usually those clients are clients also of all the other associated party here in the funds. So there's a competition, and you want to capture immediately by saying, hey, if you go to Fidelity, you pay 1%, come to BlackRock, you pay 0.5, and then some like ARK said 0.3 for the first 6 months. So like a one-time entry fee. It's just basically marketing. Okay, it's purely marketing, trying to capture us as early investors as possible, because they know that then if you have this bigger fund than the others, then you have the larger institution, pension funds, banks that has not bought it. They will look at getting an exposure. They will look at who holds the most in this space, and then they have this page that you have open up in Bloomberg terminal and say, oh, let me see, well, Grayscale 2 billion, BlackRock 1 billion. Okay, let's get a bit of Grayscale, I mean the most of Grayscale and a bit of BlackRock. That's it, that's my exposure.
Thanks, Marco. Basically, a battle for market share, but it's going to be an expensive one, or pre-investment on future profits, because at the level the fees are right now, we can't expect early profits from any of these institutions, but I guess they're backing for the long run. So let's just jump on to pros and cons. I think you've already covered many of these, but just quickly running through what's one and the other. So if we run through what Bitcoin stands for versus its ETF equivalent, well, let's start off with an asset class. Bitcoin is largely considered a commodity by most regulators, although perhaps the first man-made or technology-made commodity, and the only scarce one, by the way, the only one that cannot be supplied in excess of what's programmed in the Bitcoin blockchain. The ETF is equity, trades like equity. As far as regulations go, Bitcoin pure is still subject to a maturing regulatory landscape. It's still novel. The SEC has blessed it. MiCA has come out in Europe, but still somewhat fragmented across the world, whereas, of course, equities have been around for decades and are just another ETF added to the menu. Access simplicity is, if you ask me, pretty straightforward in the crypto space using wallets and exchanges, but perhaps not that easy if you come from the traditional financial world. If you are in traditional financial world, you're just looking at another ticker, another ISIN, another another product on the existing menu. So it's fairly straightforward. The fees I quote here are the original fees expected from the Bitcoin ETF. So they were originally expected to range between 0.3 and almost 1%, plus recurring annual fees, plus hidden costs, which come with traditional financial products. That is the nature of what it's like to trade with banks and financial institutions. With pure Bitcoin on exchanges, the fees are typically far lower and only one-offs on purchase and sale. As far as ownership and custody, you own your own assets if you're willing to go all the way of self-custody, or otherwise delegate that ownership and custody to the exchange, so effectively having a degree of counterparty risk to the custodian, to the exchange. Whereas with the ETF, your asset manager, the institution, custodies your assets. Marco explained that happens at, for instance, 21 Shares or Coinbase, and the investor doesn't really own the real asset. Couple more things. As far as security, we believe is very high as it pertains to the pure Bitcoin if held in self-custody. Otherwise, as we said, there is a degree of exposure, hacking of exchanges and the likes in the crypto world. Whereas in the institutionalized financial world, it's probably high, but as we've seen, there are counterparty risk effects in the real world as well. There are banks that go down, and when that happens, well, getting access to your assets may not be that straightforward. I think importantly, some of the main aspects are the ones we're just going to finish off with. One is around trading and management of your crypto. When holding your own crypto and trading on your own account on exchanges, you're totally in control. You can go in and out as you wish, anytime, 24/7, 365 days a year. On the on the Bitcoin ETF side of things, you are limited to the platform and fund manager. That means you are constrained to a degree as to how to manage, for instance, very volatile times. If the market's booming up or down, it might be tricky to limit your exposure on the downside or take profits on the upside. It's simply a question of reaction, and often trading as well. If the market's down 20% on a Saturday morning, you can execute trades on any exchange, typically provided there is sufficient liquidity, whereas you cannot do that until your banker comes in on a Monday morning, or you execute your trade on a trading platform in the traditional financial world. I think that's very important, and we will see through the next volatile cycles how that plays out and what wake-up calls we might end up seeing for any I keep calling it BTC, but Bitcoin ETF users.
Okay, just to make sure I understand Francesco here, because myself, I'm purely into crypto. I don't hold any ETF. So if I'm holding an ETF right now in Bitcoin, as you said, it means that I'm limited to the hours or the opening hours of my bank or trading desk, basically.
Trading banking hours, called specifically.
Okay, so I can still log into a platform, whatever it is. And if it's open, I can buy and sell. But if it's closed, I can't do anything.
You can instruct and they will be locked in a queue until the reopening of the next market cycle.
Okay, so yeah, I
Yeah,
understand. Okay,
think
so this
about
will
that.
have an impact, right? Because
Of course it will.
we will see execution when it's up, when the market is opening at the bank. We'll see all those orders being executed.
Under volatile times, Maxime, you're going to see the pure crypto market front run the traditional financial market, and that's going to start twisting minds.
Yeah, that's what I was thinking. Like, how do you manage? There's an arbitrage here, right?
There is an arbitrage, and that will have to start. I look at this positively, Maxime. I think we're going to have to start expecting the traditional financial world to start embracing the digital era, to start extending trading hours, working hours, and digitalize itself to mirror, if you like, the behaviors of exchanges. Let's wait and see on that. You're probably going to start seeing coverage desks on weekends. That's not been the norm this far, because there haven't been digital assets requiring that. So if you think of trading desks, for example, banks, they usually have they have coverage hours, right? Because the equity markets are open throughout the sort of the trading day, from Australia open to the US close. So not quite 24 hours, but almost. So they have these extended coverage hours. But that stops, for example, on a weekend. So my prior example, on a Saturday morning market crash, they're going to need to start managing that sort of exposure. I think we've covered price and performance.
Okay, can I just add one small thing, and then if this is interesting, we can continue on another session. But there is a caveat to that, because that's already happened to some extent in the currency world, and it's called internal banks. As Francesco was saying, international banks have, during the week, almost 360 coverage, because of what they could do is trading with their desk in Australia or in Hong Kong, or in the Europe, while US is basically not active. And during the weekend, what they do is this, usually around Friday, they start the AB book, and they collect internally on Treasury asset, so that can be for extreme emergency being used during the pre-market opening on Monday. Basically, if you have enough treasury, then you can trade against yourself instead of going to the market, right? And that gives you a little bit of buffer, or a little bit of let's say capability cushion for what's happening.
And I have just one little question. But for example, speaking about the security and how the Bitcoin is held by the funds, if Bitcoin is held by funds in Coinbase, for example, isn't the security moderate just as if I'm holding it on an exchange?
Yes, it is. I meant the security of the asset in question. So
Okay.
so the security the investor has is the ETF, is the right.
Yes,
The actual
and
asset is held by your financial intermediary.
And do you see a possibility of Bitcoin being held by the funds like on a ledger instead of Coinbase in the future, just to make this risk even less?
Maybe this. So I was in discussion with Coinbase actually 2 years ago for a different reason, and they were starting a new product called Prime. Okay, that Prime was put out of the market quite lately, I would say, and because that became the institutional product. So that they have a different custody than me and you can have in Coinbase. First of all, it's an institutional. It's an institutional custody service, and it's very similar to a certain extent. There are some integrated capabilities that look similar to Ledger.
Okay. No, because I was thinking that being able to see the transaction on the blockchain made by those who held the funds would be really cool. But
I'm not sure it's going to be that easy.
I understand.
Maybe what I didn't put in here is that ultimately, though, my personal view, I'm a little bit conflicted here, but if I take a philosophical read of this, the pure Bitcoin marries, if you like, owning Bitcoin the pure way, marries the ethos, the spirit, the reason why this whole thing even exists. Holding a decentralized asset on a completely sovereign basis and be able to sort of enable peer-to-peer transactions if that's what you like to do. Holding a Bitcoin ETF is just a derivative of it. It's the sort of traditional financial world version of it. And perhaps for this whole ecosystem to prevail in future, we probably just need a bit of both. So for everyone, their own assets and their own sort of option. But there you go. I think we've covered the different aspects and what you need to know if you want to go into one or the other. If you have been in Bitcoin, well done and congratulations. So there you go, Marco, you've covered the SEC hack. Here we go. Here we have it represented in the chart. You can see how effectively, due to a control failure at the SEC, whereby, as we've then learned from X's security, so Twitter, now called X, is the platform through which the illegitimate post was made with the announcement of the SEC approval. We've learned through X's security that 2FA, two-factor authentication, was not enabled in the SEC's Twitter account, which is a pretty basic information security control. And quite frankly, for the regulators and the preachers of security across financial markets not to have such security is frankly quite shameless. And the repercussions of that, as we can see from the chart, are pretty significant. So we can effectively, I don't think I'll be short of telling the truth here, but effectively the shortfalls of internal controls at the SEC affected and manipulated the financial market, at least the Bitcoin crypto market, for a period of time. It then restabilized. And
I want to launch a provocation here because I really like the duality of this. So like the SEC was always against Bitcoin, and by the way, when it was approved by the SEC, Gensler posted a tweet saying that he doesn't advise, which is pretty strange. It's like you on one side you allow it, and on the other, yeah, but it's a bad thing. It's like, okay, how that works. But aside of that, and I think there is something going on in the US about this. If your mandate is customer protection and you always complain about Bitcoin volatility wiping out clients, and you yourself are the cause of that mentioned volatility, then you should persecute yourself as a bad actor, a generator of the volatility, a potential generator of risks for customer investors.
Yeah. We know the SEC has triggered the FBI apparently to look into this question, but I don't think they'll have to look far from just realizing that there was just a blatant control failure within. And no doubt the SEC is going to have to respond and provide some good backing and future actions to get around this embarrassing moment. Let's move on. I think we're pretty much at the end.
But just to add up here, for me, it's crazy. First, they don't have 2FA, right? But there's just one thing, because I've been managing Twitter account and protecting them. So it's very basic. You set up a 2FA, you don't use SMS verification, you use an authenticator because it's more safe. But they also said at some point it was messy because they talked about a SIM swap that I don't believe neither, because imagine calling AT&T and say, oh, look, I'm the SEC, I have a new number. Whatever, the procedures have to be like super strict. For me, it's almost impossible. And I guess this is just my take, but it's a human mistake. There is a human behind it who posted it at the wrong time, but I don't really believe in a hack. And we will maybe never know the truth about it. Because imagine just being the ACC and have to face, oh, we did a mistake. We posted it. one day too early, or whoever
Yeah.
did it, and they will find the right, scenario to make us digest it. But I don't take it.
Look, I've heard so many different versions on the story, including that it was a deliberate action from the SEC to give them time to the market to prepare, and then officially give the green light a day later. I tend to agree with you, Maxime. I think it's an internal failure, whether it's a human error, a process error, a combination of both. The result is, anyway, in the eyes of the public, an embarrassing result, and one the SEC will have to clean itself from, or otherwise try and forget as quickly as possible. Let's quickly move on to stable coins, or maybe unstable coins, and perhaps slightly provocative. Mark, I know we've spoken offline or exchanged a little bit about this, but the S&P, which is is well known for its rating capabilities in traditional financial markets, have come out with a stability assessment approach for stablecoins. I just attended their webinar a couple of days ago, and that's where the slide comes from. This is just an example. I think Dai's in the same seat, but I thought it was interesting that they were on a 1 to 5 scale basis, where 1 is great and 5 is, 1 is very strong and 5 is weak. Both Tether and Dai, Tether in particular being the third largest crypto asset by market share in the world, was given a 4 rating. And that's primarily given to the perceptions of riskier reserves than other stables, or the other equivalents that would probably better peg or track the value of the dollar, as well as murky and not quite so transparent disclosures around how those assets are held. We haven't shown them here, but you could do the research and look at the balance sheet for Tether and make your own mind up as to how transparent that is. If you ask me, I think it's still presented in fairly headline ways in terms of macro asset class, but we don't actually see the positions. It's difficult to judge from the outside as to what those assets are really held in. In the past, I think we've heard of suggestions that Chinese real estate, for instance, was held through the form of commercial paper in the books of Tether, but who knows? So Marco, Maxime, or David, what are your take on this, and does this have any ramifications, you think, in the near future?
I guess, first of all, we don't have a chart here, but when you look at the chart of USDT, it's quite impressive. When we print USDT, Bitcoin goes up. If you look the 15th of October, the number of USDT on the market reached a new all-time high, and we're heading higher since then. 15th of October 2023. And the other stable coins are losing market shares. So it's we discussed it in the previous session, but somehow it's the backbone of this industry, of the derivatives over the smaller cap trading pairs. And if we don't trust, I mean, it's a very sensitive topic, because if US Tether is threatened at some point and they don't have a reserve, for example, or they cannot back 1-to-1 with USD, this whole market will struggle. I think it's the biggest risk we have at the moment on this market, in my view.
If we link it back to Bitcoin and the rest of the market, right? The market is at 1.7 trillion, with USDT being the largest stable coin. And what is a stable coin? It really is a sort of the on-ramp, off-ramp. It's the liquidity part of the crypto market, where users can, if you like, when taking profits from BTC, ETH, or whichever coins they hold, they can switch it into USDT or other stable coins, instead of converting it back to traditional sort of dollars, euros, pounds, and then back on to crypto. That's the whole sort of purpose and raison d'etre, as well as settling an enormous amount of trading pairs in the crypto market. So I agree, Maxime. If there was anything to happen to what is now even more concentrated, the most concentrated stablecoin on the market, it worries me inherently. Aside from this rating from S&P, I would love to know and love to see far more proactive disclaimers and disclosures and transparency. And for what is almost by default out of the box, or pretends to be, or purports to be, an open source, transparent ecosystem, far better than traditional finance. Well, I think we need that sort of transparency, more transparency in this space too. But Marco, you've always got a contrarian view, so what's your take?
I think so. It's a long one, and I'm trying to think that probably this deserves its own session. So I will just give a couple of points here and there, and then let it go. I don't think that all of this stablecoin are the same, and because I think that stablecoin has been, it's a consequence, but it's not the nature of what they are. Consequence means is the consequence of being stable in towards the dollar, but it's not the nature of what they are. USDC and USDT are fundamentally different. Like, the only thing that they have in common is the procedure of redemption and minting, and the fact that they are pegged to dollar. Otherwise, nothing. I'm not surprised to see Tether under attack, to be honest. I may be wrong. I hope I'm not, but I'm also scared of being right in this case. Because to me, Tether is a competitor not of the dollar as it is, or is not a competitor of USDC. It's a competitor to the Fed, because that's the only real comparison that you can draw between what Tether is, what the Fed is. And Fed is printing money and has its own investment book, okay, its balance sheet. Tether is the same stuff. They have their balance sheet and they print money based on that. Then they have the rates of withdrawing, right? And that's exactly the same thing as the Fed has with the overnight rate deposit. So that's why I'm not surprised to see Tether under attack, because you can the let's say why it's so risky for traditional finance, not traditional finance, for the governments of the world, specifically the United States, or something like Tether, because you can go in crypto and you can even get into the real world through Tether, which is not connected to the dollar. You can run a country on Tether and be pegged to the dollar without holding one single dollar. That works, right? You have your people pay you with Tether, credit cards. The value is $1, but effectively Tether has treasury, do not require to actually have any dollar. I mean, now they have the T bonds, but technically, before they had other type of asset. As long as that fund works, that works. I understand what you say about the risk, because it's like, oh, but it's not transparent, and then I have to, this level of trust. Well, the whole financial system, banking system, and the system of currency today is based on purely trust since Nixon shock. So we are running on trust since 40, 50 years. It doesn't seem to me that this is new, and nobody had any problem with that. And we built the biggest numbers ever known to humankind. And now we put 4 on a score because somebody else tried to do exactly the same that we did. It feels like a bit strange to me. But again, I'm not sure which one of the two things are better. If I'm wrong, massive damage to the crypto industry. If I'm right, there's a lot of issue there as well. So I'm not sure.
I think we'll need to go through a full session and compare the Fed and the Tether balance sheet to really compare which one is the worst. You're muted, Francesco.
That would be a good session indeed. Let's plan for that. Okay, guys, we've come to the end of our session. I hope you found this informative. If you have, click the like button, leave some comments, click the alarm bell, and follow us for future sessions. And as always, your money in a bank isn't safe. We've covered that time and time again. If you want our advice, is explore in the crypto space, come and learn, find out more about it, and see you on the next one.
Thank you, everyone, and see you next week. Bye.
See you next
Bye.
week.
Bye-bye.
Bye.